Yeah, you don't know all the shit that I've been through, all the pain and the struggle that I lived through. Now I'm rolling up these papers that I smoked through, thinking about all the shit that I've been through. You don't know all the shit that I've been through, all the pain and the struggle that I lived through. Now I'm rolling up these papers that I smoked through, thinking about all the shit that I've been through. Now I'm sipping on this whiskey, got one chance and it's risky, so you can't play around. And I got my team behind me like a background. I don't never back down, picking up the slack now. Now I'm focused, keep on grinding for my stacks now. I'm feeling lost in this ocean, where's a lighthouse? I keep on swinging for the fence and I ain't strike out. And yeah, that's how I'm feeling, yeah, that's how I'm feeling now. We're not here for a long time, yeah. It's 9 to 5, it's a long grind, yeah. A lot of to success, it's a long climb, yeah. Now I'm sitting here making up for time, yeah. Man, I took so many losses that I lost count. I didn't know what I was made of, but I found out. And this life will blindside, you better look out. These haters wanna see you fall and get you took out, yeah. Cause I fell on my face, and this life is a race. I keep on checking my place. Now I'm riding for my team, you can tell by my plates. And this life just threw a hook, it caught me right in the face. But I'm getting back up, I'll do whatever it takes. I'll climb a couple of mountains, I'll swim a couple of lakes. Don't got time for the bitching, don't got time for complaints. Now you going through some shit, now tell me how does it taste? You don't know all the shit that I've been through, all the pain and the struggle that I lived through. Now I'm rolling up these papers that I smoked through, thinking about all the shit that I've been through. You don't know all the shit that I've been through, all the pain and the struggle that I lived through. Now I'm rolling up these papers that I smoked through, thinking about all the shit that I've been through. Now I'm living with my choices, I just own my mistakes. Cause I'm screaming fucking hand down, I ain't searching for breaks. But I'm barely treading water and this life is the lake. Now the pressure keeps on building as I'm raising the stakes. I ain't looking for advice, now I'm looking for space. Now I'm dealing with these losses, but I know I hate the taste. Now I'm sitting back, I'm thinking as I smoke it to the face. Now it's time for these apologies, the time is too late. So bygones be bygones, I'm on business with a tie on. So fuck a shoulder to cry on, I'ma get a hoppin' like Zion. Let's raise a glass, I'll toast that. Reminisce, we roast that. How I wrote them and ain't wrote back. I'm never flimsy, the goat's backs. I don't feel bad, no not at all. When a lot of years, write a lot of calls, a lot of birthdays without a call. Ain't got time for that, so fuck a fraud. You ain't there for me, I ain't there for you. You won't bleed for me, I won't bleed for you. All the hard times I lived through, keep moving, gotta get through. I got goals and cash I gotta get to, all these memories that I flipped through. If you can't relate, then don't judge. I'll stand my ground, I won't budge. I'm sitting back cause I burn buds, I swear to God this life's good. You don't know all the shit that I've been through, all the pain and the struggle that I lived through. Now I'm rolling up these papers that I smoked through, thinking about all the shit that I've been through. You don't know all the shit that I've been through, all the pain and the struggle that I lived through. Now I'm rolling up these papers that I smoked through, thinking about all the shit that I've been through.
Check out Paul P Music on Instagram and Spotify. Living Through is the name of that song. Check this out, everybody. Jim Cramer, the one and only Inverse Cramer in full effect. You guys are going to love this.
Spike in credit default swaps that occurred last night. Takes you back, of course, to the 07-08 period, credit default swaps and how closely we watch them. This is a bank that's in actually a lot better shape than it was certainly coming out of the crisis, Jim. But it's not a name that's unfamiliar to many. I mentioned it earlier this week as sort of, well, will they try and come after it? When I say will they try to come after it, I'm referring to things like even that tweet yesterday from Boaz Weinstein at Saba, a guy who used to actually trade and really created the CDS market in some way when he was at Deutsche Bank years ago, getting people worried.
Okay. I think that's a great way to put it. Oh, by the way, I'm going long Yeti here.
Okay. Yeah, that voice is still coming around.
But it's better than, okay, you were there when it went. Okay, so David, first of all, the real problem with Credit Suisse, which is the analog, is they never made any money. Deutsche Bank is actually very profitable. So let's start there. Why bail out a bank that is just a chronic loser versus a bank that's doing well? Second, if you wanted to be aggressive on Deutsche Bank versus what you just, apropos of what you said, you short the Deutsche Bank common and you buy these
buy the
credits
CDS,
and
which
blow
obviously
them out.
go up as the essentially as the credit risk is seen as increasing.
Right, and we saw that. But perhaps the most easily misinterpreted is what happened to the Credit Suisse fixed income when the government took it over. You had the country of Switzerland, of course, willing to bail out its finest name, merged with UBS. But what happened to fixed income was so devastating.
Good old Jim Cramer.
Then I think people are saying, you know what? If Germany does that, God, I don't want to be in this.
Right. Well, it's the one class of bonds we're referring to at Credit Suisse. The Swiss regulators have come out and explained their reasoning. Of course, this was a very risky class. It was related in some way. There were provisions that said, hey, if you rescue them, these things get zeroed. But it did take as a surprise. It was taken as a surprise by a number of people in the market. It was $17 billion.
I know.
Multiples of the market value that was left at Credit Suisse, which they actually retained a bit of,
yes.
Surprisingly, perhaps.
Isn't it interesting if you buy the stock of Credit Suisse, and I'm by no means recommending there's earnings power, and you may have to deal with the fact that they actually have firepower buying back one of their buying back some bonds. But I just think people say, wait a second, if Germany wants to seize it, Germany will seize it, and we're in trouble. But David,
they're not going to. I mean,
this
first of all, again, and they're not near this. Listen, I've talked
good
to a number of market participants I've spoken to this morning, and people that say that we're not overly concerned about Deutsche Bank. They will admit to being concerned about the earnings power of banks across the board right now. Their cost of funds has increased. Their willingness to make loans has decreased. And so there is a question as to what earnings are going to look like for any number of banks, and you can see that reflected perhaps in the equity. But are there many who believe somehow that this large institution is in real dire straits? No.
But David, a lot of things are coming from the governments themselves. So Christine Lagarde this morning reassures banks, okay? And I'm sure, by the way, Sarah will re-up that when she's on there today. But here's the issue. We're still going back to when the Fed raised rates, and we had that split decision between Yellen, who gave a populist Biden view on bailouts, and Powell, who acknowledged there are no bailouts, it's just credit. If all these regulators were to speak as one, saying, listen, good banks are going to be protected, which then might, good bank means positive equity. Then this goes away if they just use the term protected, because it'll be scary enough.
Yellen is coming with some criticism. I keep hearing it every time. Yellen, again, just this morning was a very senior member of the financial world, let's call it. Yellen, a little all over the place.
She is, because she's political. Which is something I thought was
been a little all
her.
over the place, and that's not been helpful. That was a sort of a quote I wrote down. I can't tell you who said it, but
no, she played to the crowd. It was disappointing. She's usually above that. I think she should have been aware that her words were spoken.
Let's listen to the latest thing she had to say. This was, I believe, yesterday on Capitol Hill.
It's 3 o'clock.
Take a listen. A bit different than Wednesday.
We have used important tools to act quickly to prevent contagion, and they are tools we could use again. The strong actions we have taken ensure that Americans' deposits are safe. Certainly, we would be prepared to take additional actions if warranted.
She's been saying essentially the same thing, but obviously doesn't want to get into the territory. Says yes, all uninsured deposits are now insured.
But they do have a facility that they put in place, which basically says if you have bonds valued at 80, you can
put them to us
at par. And she seemed to not acknowledge that that is enough. If you have, all she had to do was say, listen, we have facilities in place. Of course, we'll do more.
Right.
It's her language. She needs to speak with the same language as another person who's in the government, which is Powell. But I thought she played on Wednesday and lost her credibility because Biden's against bailouts. So if you're going to give me a Democratic line as Treasury Secretary, then how about say we're fine? Because when you disagree with the Fed chair, you make a situation where people short everything.
And someone.
That's a good point. I am short on PacWest. I am short on Deutsche Bank. I am short on Credit Suisse and the S&P 500.
Well, the real problem with Credit Suisse, which is the analog, is they never made any money. Deutsche Bank is actually very profitable. So let's start there. Why bail out a bank that is just a chronic loser versus a bank that's doing well? Well, the real problem with Credit Suisse, which is the analog, is they never made any money. Deutsche Bank is actually very profitable. So let's start there. Why bail out a bank that is just a chronic loser versus a bank that's doing well? Well,
Ladies and gentlemen, Jim Cramer is a confirmed clown. The inverse Cramer ETF is probably going to go through the fucking roof here pretty soon. Deutsche Bank, Credit Suisse are in absolutely terrible condition. Same goes for something that's kind of slipped by the wayside that a lot of people don't even know about. Wells Fargo is in absolute terrible shape. The United States Treasury Secretary Janet Yellen today held an emergency meeting with U.S. financial regulators. Things are out of control, ladies and gentlemen, and they do not want you to know it. Janet Yellen was single-handedly responsible for stoking and restarting the banking crisis on Wednesday, which until that day was easing back, with her comments that nobody in charge was even talking about a uniform deposit insurance, let alone working on one. That today they're convening with heads of the top United States financial regulators for an unscheduled meeting of the Financial Stability Oversight Council. It is closed to the public for obvious reasons. The Treasury did not say what time the meeting would begin and what they would be discussing. Regulators continue to try to instill calm on the financial markets and bank depositors amongst the recent failure of mid-sized lenders like SVB and Silvergate, and now the collapse of Credit Suisse and their government brokered takeover by UBS. The Financial Stability Oversight Committee is basically the Federal Reserve, FDIC, the OCC, the Consumer Financial Protection Bureau, the Securities Exchange Commission, the CFTC, the Commodity Futures Trading Commission, the Federal Housing Finance Agency, and the National Credit Union Association. Jim Cramer, of course, continues to say that they are very profitable. But I find that hard to believe considering banks hold over $4.5 trillion in United States commercial property debt. The banking sector is on fire. Bank of America's shares have fallen to the lowest level since November of 2020, since the COVID crisis. Check this out. Look at this beautiful little chart. $1.749 trillion is held of commercial property debt is held by banks, and nearly $400 billion of debt matures this year as these regional failures in banks continue to threaten the number one source of financing for these guys, which is mortgage-backed securities. Also, there's almost $500 billion of loans that come due in 2024, so that's almost $1 trillion between this year and next year, according to MSCI Real Assets. And about 27% of all financing for these real estate loans comes from local and regional banks. Property owners who need to refinance are going to be seeing much higher borrowing costs and a greatly decreasing property values. You got Silicon Valley Bank and Signature Bank basically making negotiations even harder as these local lenders scramble to reduce their risk. There's no ifs, ands, or buts about it. And this is already happening. Major U.S. banks are scaling back their appetite for these real estate loans in the second half of 2022. And what's even worse is commercial real estate is at a level that we have never seen before in this country. What we saw in 2008 was strictly due to the residential real estate market and foreclosures going through the roof at that point. But now, a lot of people think that residential real estate is safe, but that's not the case. Residential real estate is nowhere near safe. And we're about to see, and I'm about to prove to you, that there's a major inflection in foreclosures coming, both in commercial and residential housing. These office owners have been struggling amidst these higher borrowing costs and the increase in remote workers. There's $40 billion worth of properties in the likelihood of distress right now, and a quarter of all these loans that mature this year alone. You know, there's a major slowdown by local banks because of this turmoil that's hitting small businesses. And the average loan from these local banks was $7.6 million. For national banks, it's $14.5 million. And for insurance companies, it's $24.4 million. Bank loans maturing this year are a smaller share of debt coming due than commercial mortgage-backed securities. And banks are tied to more than 50% of the loans that will also mature in 2026 and 2027. So banks of all sizes combined for $1.75 trillion of the total $4.5 trillion of outstanding U.S. debt on commercial and multifamily properties at the end of last year, 2022, according to the Mortgage Bankers Association, the MBA. With these higher rates and this poor outlook, the number of commercial property deals dropped 51% in February of this year, from a year earlier of 26.9 billion. Prices are down 7% in the 12 months through February and 8.7% in apartment buildings. According to Unusual Whales, U.S. banks are sitting on $1.7 trillion in unrealized losses. The collapse of several banks has raised concern about the safety of the U.S. banking system. Regulators and business lenders have been assuring consumers that banks are safe and that the potential for contagion throughout the financial system is slim. This is absolute nonsense, ladies and gentlemen. They say that rising interest rates have led to unrealized losses, and U.S. banks have had unrealized losses of $1.7 trillion at the end of last year. Nearly $7 trillion out of the $17 trillion in total U.S. bank deposits are not insured by the FDIC. The FDIC only has $1.5 trillion anyway. If half of these uninsured depositors decide to withdraw their funds after recent bank instability, it could put hundreds of billions of dollars of deposits in jeopardy. And some politicians argue that the Fed should have backstop every type of depositor at all banks to prevent further bank runs, which is an absolute joke as well. Check this article out here and this post by Bianco Research. They claim that Deutsche Bank has fundamentally modernized and reorganized its business model and is very profitable. But when you take a look at this is not the stock chart of a company that has fundamentally modernized and reorganized its business model and is very profitable, as Scholes contends, says Bianco Research. He says, if you bought it when it was located in a different country and dominated in a different currency, you are still sitting with a loss decades later. The last time they were at this price was in the late 80s and early 90s when Deutsche Bank was situated in West Germany and trading in Deutsche Marks. We haven't seen anything yet. Check out these home foreclosure numbers. Home foreclosures have ticked back up in the recent months. Oh, here you go. There's 2020 through 2022. The reason they were so low was because of the eviction moratorium and the amount of money that was going out to home buyers and homeowners and tenants as well to prevent them from getting foreclosed upon. That is gone. Even though they're still currently below 2020 COVID levels and not really close to the foreclosure crisis of 2008, that doesn't really matter because this is a return to what happened before 2007 and 2008, before the pre-pandemic era housing assistance programs. Those are all being phased out, and people who hadn't been paying their mortgage are working out new arrangements, selling their homes, or going into foreclosure. And as the housing prices continue to decrease, housing values, we're going to see an uptick in foreclosures again. Ladies and gentlemen, if you've been watching this channel for an extended period of time, you would know that we called for the CPI increases back in 2021 well before they began because we saw them begin to uptick and we knew that that was going to come next. Now we're seeing United States home foreclosures begin to uptick, and just like we got into an era of hyperinflation, which we have not finished, by the way, just because it has peaked does not mean that hyperinflation is over, and I'm going to prove that to you as well. Same thing goes here for housing. This is not just a return to the norm. This is going to be a return to pre-2007, 2008 levels of foreclosure. as these foreclosure starts are increasing, the overall levels of distress in the mortgage market are going to increase as well. Take a look at the median home prices. 2007 through 2012, there was a decrease year over year, month over month in home prices as a percentage change of median price. Then we had great massive increases over the last several years, over the last decade and a half, basically, and the major uptick was from 2020 through 2021 as people received record amounts of free money from the government, which fueled hyperinflation to the point where we are now, the Ponzi scheme. And now for the first time, as a percentage change of median price from a year ago, we are starting to downtrend. For the last 3 months in a row, we have seen home prices drop for the first time in decades. Homes are on the markets for longer, inventory is rising, and they're selling for less. Some people still think there won't be any foreclosures. That's not the case, though. Remember what he said here. Foreclosures are trending higher. In the 1980s, bank failures, higher interest rates, high unemployment led to years of double-digit quarter-over-quarter growth in foreclosure numbers. And we're going to see the same thing now, because even though unemployment numbers are technically low, the number of people out of the workforce is at all-time highs. Around 126 million Americans are out of work. Smaller banks are currently holding around $2.3 trillion in commercial real estate debt. It includes rentals, apartments, and that's almost 80% of all commercial mortgages held by banks. This year will be absolutely critical, people. There's about $270 billion in commercial mortgages alone that are set to expire, and most of these are held by banks with less than $250 billion in assets. Check this out. This drop and these changes put 186 banks at risk of failure. 186 banks. And all of these banks have their bonds and collateral rehypothecated many times over. That means borrowed to other banks. And at the average, the median U.S. bank, we're looking at commercial real estate loans accounting for 38% of all loan holdings. Right, 38%. Check this out. From the Kobesai letter, collapses of large banks on Fridays. Friday, March 14th of 2008, Bear Stearns was hit by their liquidity crisis. On September 12th of 2008, it was the last trading day before Lehman Brothers declared bankruptcy. Friday, September 26th of 2008, WAMU, Washington Mutual, was seized by regulators, marking the largest bank collapse in U.S. history thus far. On Friday, March 10th of 2023, Silicon Valley Bank was seized by regulators, marking the second biggest bank failure in history. Friday, March 10th, 2023, Signature Bank saw $10 billion in withdrawals and was seized by regulators 2 days later. Friday, March 17th, 2023, UBS took over Credit Suisse to avoid its collapse. And today, Friday, March 24th, 2023, Deutsche Bank credit default swaps hit a 4-year high on contagion fears. This is not unrelated. Everything is related. Just about every large bank failure in recent history has occurred on a Friday. Just like getting let go. There's a reason people are fired on Fridays. So they don't come back in the following day and shoot up the joint. And it's pretty similar to people that hold money in these banks. The major problem is that banks are ramping up the use of this new facility, right? This is called the Foreign and International Monetary Authority, the FEMA, F-I-M-A, repo facility, all right? They establish repurchase agreement facilities for foreign monetary authorities, like the Swiss bank, for example. And they say that creating this backstop of temporary dollar liquidity can help basically address pressures in the global dollar funding markets that could otherwise affect financial market conditions. And supposedly it's meant to help to support the smooth function of financial markets. But we're going to see that every time this happens, we have a major stock market, bank, and real estate collapse. Institutions borrowed $53.7 billion from this bank term funding program as of Wednesday. Right? This was on March 23rd. That was up from $11.9 billion last week and $0 the week before that, ladies and gentlemen. So we're from 0 to 12 billion to 53.7 billion so far. Another category of loans, according to CNBC, made mostly to shuttered banks to meet obligations to depositors and other expenses jumped as well. These borrowings surged to 179.8 billion from 142.8 billion last week. And this was introduced March 12th to alleviate similar strains on banks and institutions. Check this out. Officially called the Bank Term Funding Program, it leverages emergency lending powers that the Fed has had since the Great Depression, ones that central banks can use in unusual and exigent circumstances with the sign-off of the Treasury Secretary. Right? That is what, in layman's terms, this means. Big credit to Finance Lancelot on Twitter for this graph. And I could also go to Fred, and check that out. These are assets repurchase agreements on Wednesday level. This is that emergency backstop program. Look at what happened here in 2008. They went from not using it all to blowing up this facility for usage, in the billions of dollars, hundreds of billions of dollars from 2007 through 2010. Then it wasn't used for this entire decade, over a decade. Now again, during the COVID pandemic issues, we saw it jump up to over $450 billion right here during this recession. Now we have seen it. You see that little tiny blue line? Yeah, that's not that tiny. That's 70 billion fucking dollars. That's what that is right there. $70 billion is what that tiny blue line indicates. By the time this is over, the use of this facility will dwarf what happened in 2020 and 2008. The Feds injected $300 billion into their balance sheet, and these repo operations this week began. This is the final warning before a crash. It's a self-fulfilling prophecy and confirms that interbank lending between banks has stopped, and we're on the verge of a fucking crash. The Federal Reserve knows this, the Treasury knows this, the banks know it, and now you fucking know it too. Here's more bullshit information from the Bank Term Funding Program by the Fed. I'm not even going to get into this right now. It's all a bunch of bullshit anyway. Here's their extraordinary liquidity and lending facilities. Look at what happened during COVID. Went up to $750 billion through these peak sizes. $780 billion was the total between pandemic programs, discount windows, credit extensions, foreign bank swap lines to bail out companies like Credit Suisse, foreign Centbank repos like FEMA to bail out central banks around the world, dealer repo operations, reverse repurchase program operations, bank term funding programs, you name it. You name it. And this includes pandemic facilities such as the Paycheck Protection Program, Municipal Liquidity, Main Street Facility, and their term ABS loan facilities. The writing is on the wall. It is clear as fucking day. If you have half a fucking brain, what is going on here? The Fed updated their balance sheet, says Bianco Research. But you know what else they did? They injected $300 billion into this balance sheet, ladies and gentlemen. All right? Liquidity injection has driven all S&P 500 bull runs since 2009. All of the bull runs that we've had since 2009 has been due to liquidity injections. But that's not going to happen this time. That's not going to happen this time. 50% of all the QT, quantitative tapering, that occurred last year has been reversed in one fucking week. And Silicon Valley Bank was the biggest bank failure since '08. The Fed stabilized the banking sector by providing liquidity that undid more than half of all of their QT last year in 1 week. Their balance sheet has expanded for the first time since 2021. You can see it here. It's clear as day. Since 2009, the Fed has positively correlated with equity prices. Check this out. There's no denying this. And now, amateur investors and those with that are walking around with blinders on expect this current balance sheet expansion to do the same thing. I love to win. I just want to say a huge shout out and thank you for your support, my friend. So, low inflation and low rate macro environments provide a good visual representation. That is not what we have right now. We have massive inflation and massive rate hikes going on right now. Regional banking ETFs have fallen over 30% in the last 12 days. In the 8-period rate of change reached levels only seen 5 instances prior in the last 15 years. 2008, 2012, 2016, 2019, and 2020. And now it's happening again. And in each of those previous instances, inflation was under 4%. That's not the case anymore. All right. Here was the 4% inflation level. The Fed started QE in 2011, and look at what happened. Here's the inflation rate, the Fed cutting rates. Look at what happened here. In 2011, the Fed started QE, and in 2019 and 2020, they cut rates. Today, CPI is way up here at 6%, and that's using the recently updated and reweighted CPI calculations. This is much higher than the Fed's 2% target. This does not allow the Fed to step in and aggressively cut rates. The Fed is trying to stabilize banking, but they can't go in full-on print mode to avoid losing credibility in fighting inflation. And that, ladies and gentlemen, is why gold is another store of wealth for people. That's why gold is soaring. Check out the price of gold over the last month. Up 11% in just 7 days. In September 2008, the Fed's balance sheet was expanding extremely aggressively. Okay? And equity markets were still in a meltdown. And during that period, as I just showed you, gold was rallying and is rallying again while stocks decline. It's very similar to today's setup. Check this out. A massive waterfall sell-off in the S&P 500 fueled the Fed balance sheet expansion here in order to get people to move back into the markets. And that balance sheet expansion is the only thing that has been propping up our markets this whole time. Gold has been etching higher ever since, and central banks are buying more gold than ever. Now, a lot of you are probably wondering why stocks were not rallying in September of 2008 when they were expanding their balance sheet. It's because the credit risk was rising, just like it's rising today. Since SVB's collapse, Silvergate's collapse, FTX's collapse, etc., this explains why the Fed is not triggering a big bull run. Stocks are not benefiting from this. Precious metals are, just like in 2008. And the credit spread is spiking even further. In 2008, the systemic risk was due to popping household credit bubbles. Today, it's due to popping commercial real estate bubbles, popping stock and tech sector bubbles. Residential real estate around the world, and the United States primarily, are at all-time highs. Today's banking crisis is accelerating our path towards a recession, and there's no doubts about it. The Fed and banks will need to tighten their lending standards to prevent more financial runs. Take a look at the bond market. The levels of volatility in the MOVE index, MOVE, the Market Option Volatility Estimate Index, are higher and similar to what we've seen in 2008, 2009. And we are barely getting started. The volatility has driven the S&P 500. Okay, there's a strong correlation between the inverse of the MOVE index and equities through the 2022 bear market. This is a divergence, as equity investors basically have been complacent about the Fed's ability to increase stocks, right? And the broader market is showing signs of a recessionary trend. As stocks and oil decrease in price, gold and treasury and silver will increase in price. Oh, we'll get to that in a moment. But as you can see here, the Fed has increased its balance sheet by $400 billion in just a matter of weeks. That basically takes away 50% of all QT reduction that occurred last year. This week, the bank's term funding program that we just discussed increased by $53.7 billion. That's a $65.5 billion increase in the first 11 days of this fucking program. The discount window usage is separate from the bank term funding program. The discount window is $110.2 billion in the last week. And this is not QE. This is not quantitative easing. There's a distinct difference between QE and what the Fed is currently doing, leading to its balance sheet increases. Okay, when the Fed undertakes QE, they're primarily buying bonds like treasury bills and mortgage-backed securities from institutions with no defined time period, basically, in which they plan to sell them. And they do this with money that didn't exist previously. So a bank would sell their bonds to the Federal Reserve, for example, and then this creates newly printed money, which goes to the Federal Reserve. From the Federal Reserve, and it goes to the bank. All right, then the bank lends out that money, rehypothecates it, and the money that was loaned is then used to buy things that stimulates the economy. That's QE. The difference here is that the Fed is now lending money to banks to allow them to meet their immediate financial obligations. All right, and banks need this money urgently in order to service deposits that are leaving the banks in their increased volumes during this crisis. These are financial runs. The Fed has created these lending facilities, and the new facility called the Bank Term Funding Program, which basically offers the option to post bonds and these MBS, mortgage-backed securities, as collateral at their original price in return for cash from the Fed. So as the market crashes, these mortgage-backed securities will lose value. So one of the big reasons that Silicon Valley failed is because they were forced to sell bonds while they were currently worth significantly less than what they had purchased them for. Okay, this was realizing their unrealized losses. That is what we were talking about earlier. Okay, all of these unrealized losses here. And if SVB were able to borrow against their bond portfolio at their original purchase price, they may have been able to be saved. But again, the Federal Reserve is always breaking shit. So by creating the BTFP, the Fed has said to banks, don't sell your bonds, we'll treat them like cash and give you dollars equal to the initial price paid for the bond. And then you can pay us back later, but they still have to pay it back. This provides banks with protection, and they no longer have to sell their bonds and mortgage-backed securities to raise the money for this. All right, this allows them to pay their obligations and meet all the liquidity withdrawals. But it's important to remember that the BTFP is not giving them money, it's lending them money, and the money has to be given back in a year. This is substantially different from when the Fed was undertaking QE and expanding their balance sheet indefinitely, okay? A big difference here is that the money the Fed is giving these banks is through their current balance sheet is unlikely to be used in a way that will lead to economic stimulus. Hence, our economy is fucked. And the same goes for the discount window, okay? The banks can borrow money over short periods of time and they got to pay it back. It's not a permanent injection of liquidity. So basically, QE expansion of their balance sheet is permanent injection of cash into the financial system to stimulate the economy. But what we're seeing right now are cash loans, and they're backed by these shit bonds and mortgage-backed securities that are going to be continue to lose value as commercial and residential real estate collateral to help tide banks over. And it's all temporary. It's all temporary.
They become essential service to the central bank.
And this all leads to what? Hyperinflation and a collapse of our global financial markets. At the same time, huge shout out to Santa Surfing. She posted that today Evergrande's stock price fell by 95.71%. Now, if you're new to the channel, you're probably wondering, what does a Chinese real estate developer have to do with America? Well, this Chinese real estate developer has corporate bonds to the tune of, I think, $500 billion that are owned by hundreds and hundreds of banks around the world. Europe, America, Asia, Africa, South America, you name it. They are not just in China. These bonds are held all around the world by hedge funds and family offices and other banks and prime brokers and broker dealers and such. And all of those, especially ISDA members, maintain their full historical value of these bonds. When Evergrande goes bankrupt, all of those hundreds of billions of dollars in bonds, $500 billion worth of bonds, will become utterly worthless collateral. So short hedge funds and family offices holding those bonds will have to come up with more money. But until now, they're still getting 100% value on those bonds, just like they're getting 100% value on those mortgage-backed securities. You understand yet? If not, I don't think I can fucking help you. Inevitably, there will be a final rate hike and a reduction of rates by the Fed. When? It's coming sooner than people think, but not before things get worse. Things always get worse after the Fed pivots. The Fed is always late to the ball game. And what happened after the last rate cut? The S&P had a downturn of 33.47% with a drawdown of 48.82% in 2000. And then in 2003, after the tech crisis. Then after the GFC in 2008, after the Fed pivot, the S&P 500 saw a downturn of 26.36% and a 49.99% drawdown. And then in 2020, they saw a 4.82% change in the S&P 500 and a 29.5% drawdown. The Fed continues to raise rates. Inflation is out of control. Real estate, automobile, commercial, tech, stock markets, all around the world are extremely overvalued, and we won't begin to see the true bottoms on the S&P 500 until after, and the real estate facility markets, until after the final rate hike, most likely. And the final one I have for you here are the S&P financials. Taking a look at the XLF ETF, the Financial Select Sector, the Spider Fund on the NYSE, as of March 24th, 2023. MAC 10 here, Suburban Drone, posted. Wave 3 of the drawdown has already started. Look what happened. 1, 2, 3, 4, 5. Then we've got A, B, C. Section 2. Powell rates are going higher. 4 bank failures. Quote, outliers. Now, Powell rate hike and more to come. Still, we've still got more room to move downwards in the financial sector and in the S&P 500 and in real estate and in every other fucking sector. Then comes the rate cuts, and then we've still got more room to fall. Hey says, I'm about to go shopping at the store using historical prices. Yeah, I'd say that'd be a really fun game if we could all do the same thing. The thing about Evergrande as a Chinese real estate developer is that people really fail to understand just how many banks around the world are going to be affected by this. And that leads to complacency. That leads to people losing their life savings. And what happens when banks lose hundreds of billions of dollars and prime brokers and family offices lose ridiculous amounts of collateral? Margin calls. Margin calls occur. And highly over-leveraged positions, short positions, and unrealized losses become realized. And things like silver and gold and meme stocks are highly likely to go to the fucking moon. I'm not a financial advisor. None of this is financial advice. Do your own research and your own due diligence. These are just my findings and my thoughts on the matter. That being said, we're still going to be so fucking rich. And sadly, the majority of people, less than 2% of people in the world, own silver and gold. 2% of people own physical silver and gold. And even fewer people own heavily shorted stocks like AMC and GameStop, which are seeing 23, 24, 25% reported short interest. We don't even know how much short interest is held in synthetics and phantom shares and swaps, derivatives, rehypothecations, shorts marked as long. We don't even know how much is hidden in married and divorced puts. At the end of the day, I wish you peace and wealth. Hedge yourself properly. Practice in maintaining your family safe. Practice with your firearm. Have your bags ready. Keep food and precious metals and other stores of wealth available to yourself. Tangible assets. Hedge yourself whatever way you see fit. On that note, ladies and gentlemen, I wish you peace and wealth, because we're not from the right or the left. We're from the bottom, and we're coming for the ones on top.
J Squad.
Gonna be so goddamn rich.
I think it's time to blow this scene. Get everybody in the stuff together. Okay, 3, 2, 1, let's go.
Gonna be fucking rich. I want my fucking money. Griffin, I want my fucking money. that fucking money.
You're an original,
Hey,
aren't
yelling,
you?
Cowboy.
give me the fucking money. Get the goddamn money printer out.
Great. Bounty letter.
We're so fucking rich. Get the goddamn money printer out. Huge shout out. Just want to say thank you to Gene and I Love to Win. I'll take a look into that. Appreciate all you guys. Remember, I ain't selling until they fire Janet Yellen. I'm holding until Citadel folding. I ain't through till they liquidate .72. Just want to say huge shout out. Thank you to everybody. Appreciate your support. Appreciate you for joining us for the stream and for the video. Wish you peace and wealth.